Hello and what's up to you all accounting buffins. It is a lovely Thursday and you know it is time to learn more on accounting and Learn Extra right here on your best show for learning. My name is Abram and I'm here to give you a whole lot of dose, fun of learning and answering of your questions and make sure that we're clearing whatsoever questions that you have. It's going to be a fun show. It's going to be a great show. We do have Mahesh who's going to be teaching us, and we also have another guest which is Arjun. Arjun, how are you?
Good, thanks, and yourself, Abram?
I'm good. It's good to have you. It's a relief for me because Mahesh is not going to give me some questions, so we're going to give you all the questions. Are you ready to learn more?
I'm very excited indeed.
Awesome. Well, my sisters, I hope you had a great day at school. Share with me on facebook.com/learnextra. How was your day? Your accounting class especially. Otherwise, if you have some questions, feel free also to throw them on Facebook. Follow us at Learn Extra and make sure that you download your notes all for free at learn.mindset.co.za. That's how we roll. It's all for free, Mindsetters. Tell your friends to like our Facebook page because currently we're at 70,180 likes. So make sure that you get all your groups, your group mates, your friends, your class teachers, and everybody to like our Facebook page. But before I end it, we do have an awesome campaign whereby you stand a chance of winning an awesome pair of tummy takers. All you need to do is to caption the picture that is posted on Facebook with any words. It could be something inspirational, something that means a lot to you, because our title is #WalkTogether. And then after that caption, you tell all your friends to like your caption. The caption with the most likes gets to win that pair of tummy takers. Winners will be announced tomorrow at 1 p.m. So do check out our Facebook page to see if you are a winner. But for now, we're going to be moving right along to Mahesh.
Okay, wow, 70,000 likes, that's fantastic. I
Yeah,
can't
it's
believe
great.
it.
But we can still take it further.
Yeah.
Our aim is to get at least 75,000.
Okay, brilliant. I know that's going to happen.
Soon we're getting there.
Yeah.
Right.
Okay. Right, guys, in today's lesson, we're focusing on analyzing financial statements and its purpose. In other words, why do we analyze financial statements? We're going to consider certain uses of financial statements, and we're also going to discuss ratios that needs to be calculated when completing or analyzing financial statements. Right, let's now move on to the challenge question. Abram, is that fine?
Yes, please.
Okay, so let's look at the challenge question before we get started with the actual lesson itself. Today, guys, I'm asking you something that you've done already in grade 11, so this should not be too difficult. Let's go through it. The following information was extracted from the financial records of XCT Limited. You're given 2014 as well as 2013. Remember, 2014 is the current year, 2013 is the previous year. So there are a number of financial indicators that have been provided, and the question given, the directors are concerned about the liquidity position of the company. You are now required to state whether you agree or disagree and explain by quoting 3 financial indicators to support your opinion. So Mindsetters, that's a challenge question. Start answering. I'm sure you're going to get this correct. Right, we're ready now to move on to ratio analysis. So let's start by looking at firstly, what is the purpose? Why do we have to analyze financial statements? There are a number of ratios that can be used to allow users of financial statements to interpret financial information more accurately and make informed decisions. In other words, remember guys, by looking at a completed income statement or a completed balance sheet, sometimes it doesn't give you the information that you need in order to make certain decisions. So for example, if I have to give you operating expenses as an example, operating expenses for the current financial year is 300,000 Rand. That might not mean a lot. You don't know whether this is high or too low. But however, if I had to give you the percentage of operating expenses on turnover is 30%. Now that makes more sense. In other words, you can now decide whether this is probably too high or certain control measures need to be placed in order to cut down on operating expenses. The ratios help us to, so let's carry on. The ratios help us to check whether there is growth or stagnation in the business. Compare current results to previous results. Here we're talking about financial information, current year being compared to the previous year. Check results against your competitors' results. In other words, how are you doing in relation to your competitors that are selling the same product or rendering the same service? Compare results to alternate investments. Remember, as shareholders, you invest in companies hoping to make a big return, and obviously you compare this to other investments, like perhaps taking your money and investing it in a fixed deposit instead of buying shares, so alternate investments. Then, the last factor to look at, determine the degree of financial risk by investors or creditors. In other words, if we take creditors as an example, I am granting credit to a particular company. Will they be able to pay me back or not? Right, let's now move on to stakeholders who use financial statements. Stakeholders, we're simply referring to your users. Okay, this could be individuals, this could be other organizations who are interested in looking at company financial statements. So you have your board of directors, okay, then suppliers here again, talking about your creditors, banks or other financial institutions. Is it safe to grant this company additional loans or not? Investors, here we're referring to your shareholders. Okay, should I buy more shares in this company or should I sell my shares? Potential investors. Arjun, what do we mean by potential investors?
People that could possibly want to invest in your business. So
Correct.
people that are interested by what your business is providing to the sector in the world.
Okay,
so, yeah.
right. So potential future investors or shareholders. Competitors are also interested in looking at your financial statements, and of course, your employees, people who work for the company, they are interested in their financial results, and this will determine whether they have a job in the future or not. Okay. Right, let's now move on to ratios. And guys, you're going to find the nice thing about ratio analysis is that 90% of these ratios have been done in grade 10 and 11 and are repeated again in grade 12. So if you thought that, okay, I don't have to worry about my grade 11 ratios, sorry guys, you have to. Okay, right, let's now look at the various categories that we can classify ratios into. The first category already done in grade 11 is or are your liquidity ratios. And please remember, guys, a very common question in your exam, explain what is liquidity. Liquidity is simply the ability of a business to pay its short-term debt. Can the business pay off its short-term debt? Under liquidity, the following ratios may be required to be calculated: your current ratio, asset test ratio, debtors average collection, creditors average payment. Then you have number of days stock on hand, and the last ratio that falls under liquidity is your stock turnover rate. Okay, and as I mentioned, you did do this in grade 11. Right, the next category is risk, and here we're looking at the degree of financial risk should you borrow additional capital. Right, under financial risk, the first ratio is your debt equity ratio, which you have done in grade 11. However, this is going to change slightly in terms of the calculation. Then another ratio that falls under the category risk, but also will fall under the next category called returns, is your return on total capital employed. Okay, right, the third category, guys, returns. By returns here, we're simply looking at what shareholders are getting back in return for their investment. So in other words, these ratios that fall under the category of returns are the ratios that your shareholders are interested in. I've invested money in this company, what am I now getting back? So under this category, return on shareholders' equity, return on shareholders' equity, quite a nice abbreviation there, Abram.
Rose.
Rose, okay. Then return on total capital employed, which we spoke about already, falls under the category of risk as well. Then we have your net asset value. Guys, all of these are accepted abbreviations. Dividends per share, DPS. Then we have the last item that falls under, or the last ratio that falls under the category returns, earnings per share. Okay, right, the fourth category are your profitability ratios. And again, profitability, I'm not going to go through or read out all the ratios. This has been done in grade 10 and in grade 11. So your profitability ratios, which obviously measure how profitable the business is. The final category, guys, solvency. And here again, very common question in your exam, especially testing your knowledge between the difference between solvency and liquidity. Liquidity is the ability to pay current debt. Arjun, can I pounce on you again?
Of course you can.
Okay, solvency. What do you remember about solvency?
Solvency is the ability of a business to pay off its total debt that it's owing in the market.
Okay, correct. It's fantastic, huh? Okay, so solvency, the ability of the business to settle all its debts, and your format for your solvency ratio, and I've obviously made a mistake here. Current assets is to current liability, which is clearly incorrect, so I'm really sorry, guys. It's total assets is to total liabilities. Okay, all your assets being compared to all your liabilities. Right, mindsetters, what we've done for you is I've created a table, and in that table I've listed all the ratios that you need to know in grade 12, as well as the formulas that you need to know in order to calculate these ratios. How are we doing, Abram?
We're doing well.
Okay, are there any questions? Can I move on?
So far, no questions. It means you're on the right path because I'm seeing the mindsetters are giving me a good feedback.
Okay, brilliant.
They say keep calm and do more accounting with Learn Extra.
Okay, fantastic. That's what I love to hear. Right, so guys, this table, you can obviously use it. I'm not going to go through each calculation, but it's there for you. And what I normally tell my students is remove posters of, help me Arjun, posters of who you have in your room.
Sports stars, Ferraris.
Okay, get that out. Get all of that out and enlarge this formula sheet and stick it up on your wall. And this is something you need to look at all the time so that you learn off these formulas. Right, I think we're now ready to start with a question. So if there are no questions from the mindsetters, Abram, can I get started?
I think we can just take an ad break just for them to get the table right and print it out and post it, and then we'll come back to the questions.
Okay, brilliant. Let's
Cool.
do that.
Mindsetters, if you're still having some questions, also feel free to throw them on facebook.com/learnextra. We'll see you after this break. Welcome back, mindsetters. If you just joined us now, you're a bit late, but you can still catch up because Mahesh is on the roll and rocking with Arjun.
Okay.
Let's continue. It's now time for the questions.
Yeah, right, guys. We were busy looking at ratios, and we're now ready to look at an exam-type question on ratio or financial statement analysis. Right, the question that is given to us. The information below was extracted from the financial statements of Sports Limited distributors of various sporting equipment. Now, before we look at what is required, let's look at the information itself. Okay, let's go to the info. Right, we are given a question, sorry, the information. We're given an extract from the income statement. Then we provided with a balance sheet, and very, very important, guys, the balance sheet, I'm obviously given a balance sheet for 2008 as well as 2009. 2008 would be my previous financial year, 2009 my current financial year. Right, so given the entire balance sheet, let's move down, there we go, the entire balance sheet, and if we move on to the next page, we now have a bit of additional information as well. So I'm going to quickly read through the additional info and highlight the important aspects given to me. 206,900 shares were sold during the financial year at R6.30 each, as at 28th of Feb 2009. In other words, at the end of the current year, 417,000 shares were issued. Right, next bit of info. Earnings and dividends per share were as follows. So they've already calculated the earnings per share, EPS, for 2019 is given to me. 2008, I don't know why I'm saying 2019, it's 2009 given to me, and then 2008 as well. Then I am also given a breakdown of total dividends for the financial year. Again, total dividends will be my dividends per share. 2009, 72 cents per share. 2008, 105 cents per share. Next bit of information, C. You are also provided with the following financial indicators. So I'm given the percentage return on shareholders' equity. Then I'm given the percentage return on capital employed after tax, as well as the net asset value per share. Right, and then finally, the last bit of info, the price of the shares on the JSE has fluctuated between 680 cents and 780 cents over the past year. Okay, now guys, please remember at the start of every question, read through the entire question before you actually get started with the question itself. Right, we've done exactly that, so we're now ready to look at our questions. The first question wants us to calculate the following for 2009, and the first calculation is our current ratio. Okay, current ratio, how do we calculate current ratio? It is a grade 11 ratio. Arjun, will you help me with this?
Okay, so it'll
Current ratio will be?
a ratio between the current assets and your current liabilities.
Okay, good. Current assets is being compared to current liabilities. So there we go. If we take our current assets for 2009, okay, let's just write that down. 2009. Current assets, an amount of 320,000. 2009 current liability, an amount of 390,885. Let's just write down, this represents current assets, is being compared to current liabilities. Right, and the ratio that we are ending up with, 0.8 is to 1. Okay, guys, let me just quickly go to the information so you know exactly where I'm getting this amount from. Okay, it's coming from your balance sheet. So my current assets for 2009, there we go, there's my 320,000, is being compared to my current liabilities for 2009, an amount of 390,888. So that's where I'm getting my amounts from my balance sheet. So the first question, very, very straightforward, not difficult. Not a difficult calculation for 3 marks. Right, let's now move on to the next calculation. The next calculation, another liquidity ratio. Calculate the asset test ratio. Arjun, I'm going to ask you to help me again with the formula.
Okay, so this will be your current assets without your inventory, which is your trading stock,
Okay, so
and
current
consumables on
assets
hand,
minus stock
to your current liabilities
is
again.
being compared to my current liabilities.
Yeah.
Okay, all right, so let's look at the answer or the actual calculation itself. Current assets minus stock for 2009, an amount of 68,750. Okay, and let's go to the balance sheet so that we know exactly where we're getting this amount from. So let's go to our information. There's my balance sheet, and I'm looking for my current assets. There we go. All right, let's get our calculator out so that we can check this total. Let's try that one more time. Okay, so if I take my current assets, which is 300, okay, let's try that one more time. All right, let's try that one more time. 300, okay, not really helping me. Okay, that's fine, guys. Let me just show you the calculation. 320,000. Okay, my total current assets, and remember, I need to subtract inventory. My inventory amount, 251,250. So that gives me the first part of my calculation, an amount of 68,750. This is being compared to my current liability, which obviously remains the same, 390,885. And if I calculate the ratio, I'm getting a ratio of 0,2 is to 1. Okay. All right, let's now move on to our next ratio calculation. They now want us to calculate the net asset value per share. Now, guys, this is a new ratio. This is something that you do in grade 12, not in grade 11 or grade 10. Net asset value per share is calculated by taking your ordinary shareholders' equity, and we're going to divide this by number of shares that were issued. Okay, your answer will then be multiplied by 100 cents. In other words, your answer needs to either be in cents or you can convert this to rands. So let's look at our calculation. Okay, Abram, how are we doing there? I seem to be having a bit of difficulty.
We're doing well.
with
The
the
mindset
board.
is make sure that you have your notes, because whatever we're going over, it's on your notes. And the challenge question, already it's posted on facebook.com/learnextra. Are you still enjoying yourself, Arjun?
I'm good. I'm actually enjoying this. It's a new experience. It's a great opportunity. I'm definitely enjoying this.
That's nice. And it's good that you are actually working out with us. And I
Yeah.
should say this to other matriculants just like you. The final timetable for the matriculants is out.
Oh, wow.
Okay.
I know.
Pretty.
I'll post the link on facebook.com for you to get it.
Okay.
I'm not trying to scare anyone.
No. I'm not trying to scare anyone either, but guys, you're writing accounting in that first week.
Oh, great.
So just
Thanks,
heads up
ma'am.
on that. Right, guys, let's get back into the calculation for the net asset value per share. So my calculation as follows. I am taking my ordinary shareholders' equity. In other words, my amount from my balance sheet, 3,120,000. Let's go to the info so you know exactly where this amount is coming from. Okay, so there we go. That's my balance sheet. Equity. So your capital and reserves represents your shareholders' equity. And remember, guys, let's get a pen out. There's my 3,120,000. So this amount is now taken to my answer sheet. Let's go back to your answer sheet. 3,120,000. This now must be divided by the number of shares issued. So if we go back to our information, additional information A, we were told as at the 28th of February 2009, 417,000 shares were issued. So that is where I'm getting my figure from, 470,000. So back to my answer sheet, 3,120,000 divided by the number of shares issued, 417,000. Multiply this by 100 cents, and you're going to end up with a net asset value per share of 748 cents or 7 Rand 48 cents. Now, what do we mean by net asset value? An absolutely important ratio, guys. Net asset value tells you the worth of your shares. So in other words, if as a shareholder I want to sell my shares, I need to sell it at what the shares are worth. So currently the shares for this company are worth 7 Rand 48 cents. Okay, hope you guys are with me. Abram, are there any questions on any of the calculations so far?
Not on the calculations, rather. I have a question on based on what you started with, asking how do we comment on ratios?
Okay, how do we comment? We're coming to that. So I think let's look at the comments when we get to it, and then I'll obviously explain that in detail.
No problem.
Okay, brilliant. All right, the last calculation guy is our guys. Okay, let's do that again. The last calculation. Right, we're having too much of fun in the studio, and I need to now focus. The last calculation is your debt equity ratio. In other words, your gearing ratio. Now, in this particular calculation, we're going to be comparing your non-current liability, your long-term loans, are being compared to equity. In other words, your own capital. So we are looking at borrowed capital versus own capital. Does the business rely too much on borrowed capital? So let's start off with equity. We came across this figure in the previous calculation. Your shareholders' equity for 2009 is an amount of 3,120,000. Okay, remember guys, again, we're getting that from the balance sheet. Let's now look at our non-current liabilities for the year. So let's go to our information. Let's go back to that balance sheet. There we go. Right, in our balance sheet, your non-current liabilities, and for the year 2009, our non-current liability, an amount of 300,000. So let's take that through to the calculation. Okay. An amount of 300,000. Right, now remember guys, in accounting, whenever you're doing any ratio calculation, the right-hand side must always equal to 1. So I'm going to divide 3,120,000 on the right-hand side in order for me to get 1. On the left-hand side, I do the exact same. So 300,000 divided by 3,120,000. Okay, let's just hope our calculator is working. Arjun, if it's not working, I'm going to ask you to help me, okay? All right, so we've got...
Okay, while Mesh is trying to get that mindset, I should keep on telling you this. The challenge question is on facebook.com, and I'm not seeing anyone who's giving us the answers. I hope you're working on it. If you have your answers already, post them on the same post on facebook.com/learnextra. Arjun, are you getting your answers right there?
It looks so. It looks like it. I'm definitely working with ma'am, so I know that I can do the calculations, and looks like I'm getting them right.
All right, awesome.
Right, we got the calculator to work. So guys, all I've done is I've taken my 300,000 divided by 3,120,000 to get 0, if I round up, 0,1 is to 1. So let's just fill that in. 0,1 is to 1 is my debt equity ratio for this financial year. Right, let's now move on to the next part of the question. We're required to explain why the directors decided to reduce the long-term loan significantly during the current financial year. Okay, so that's the first part of the question. The second part, in your opinion, was this a wise decision? In other words, they're asking us for a yes or no answer. Explain quoting evidence or figures, financial indicators from the question itself. Okay, so all of this, guys, for 6 marks. Now remember, when you get this type of question, this is where you need to comment, and this is where you need to read the question very, very carefully. So the first part of the question, explain why the directors decided to reduce the long-term loan significantly during the current financial year. So if I go to my information, I'm looking at my non-current liabilities. 2008, my loan was sitting at 1,525,000. 2009, this has dropped significantly to 300,000. So the question is asking you, why have they decided to reduce their loan? In other words, to pay off such a substantial amount. Right, let's go to possible reasons. And for that, I'm going to look at certain financial indicators. Let's go to our info. Okay, right. I'm going to start off with something that most of us are familiar with, because it is a calculation that we did do in grade 11. My return on capital employed for the year 2008 is sitting at an amount of 10%. In other words, the capital that I've used from shareholders as well as for the loan itself, my return, the return that the business has achieved, is 10%. Now remember, guys, if you borrow capital, capital obviously is not lent to anyone without them getting anything back. And if you borrow capital from the bank, what do you have to pay back every month, Arjun?
Interest.
You've got to pay back interest. So let's compare the return to the interest that is being charged on the loan. So if we go to our balance sheet, again, we're looking at our non-current liability. We've got a loan, and the interest that is being charged is 15%. Okay, so hang on. I'm only getting a return of 10%, but I'm paying back interest of 15%. Does it make sense to actually borrow money? Okay, what do you think, Arjun?
Well, based on the return, definitely not, because you're paying out more than what you actually received. So you're in effect incurring an expense greater than what you should.
Okay, so in other words, exactly. So my return is only 10%, but I'm obviously paying back 15%. It's not worth me borrowing this capital, and I need to pay it off as soon as possible. So let's look at possible reasons, apart from the one that I've just mentioned. Okay, so let's look at this. Right, so firstly, the reason as to why the directors decided to pay back their loan. In the previous year, the return on total capital employed was 10%, and it was lower than the interest rate, which is 15%. Okay, another possible reason, guys. In the previous year, the company was highly geared with a very high debt-equity ratio. So if we look at, and remember, you don't have to calculate the previous year's debt-equity ratio. All we've got to do is, let's just find the balance sheet. So if we compare 2009, let's just try to get a different color pen there. 2009, my equity, 1,443,000, compared to your debt, 1,525,000. So immediately we can see that the business or the ratio was greater than 1:1. In other words, this company was high risk. They were very high geared. They relied too much on borrowed capital. So therefore, it makes sense for the directors to decide in the 2009 financial year, let's now pay off this loan, or let's pay back a significant portion of this loan. Okay, right, so let's go back to our answer sheet. Okay. Right, there we go. So that is one of the reasons. The second part of the question, in your opinion, was this a wise decision? Was it a good decision? They want an answer of yes or no. Explain, quoting evidence from the question. Now remember guys, the previous financial year, your return on total capital employed was 10%. Let's look at the return for this financial year. So again, we're going back to our information. And if we look at return on capital employed, for the 2009 financial year, this return has now improved to 24%. So immediately the return has obviously increased. So if we compare our return now to the 15%, I'm paying interest, the interest rate is 15%, my return, however, is 24%. In other words, this now clearly indicates to us that it was a good idea to pay back some of the loan. All right, let's go to that answer sheet and let's look at other reasons why it was a good idea. The saving on the interest has increased profits as well. Because remember guys, you're not paying such a high percentage of interest every month. So obviously profits, you're going to show a greater profit in your income statement. And this is indicated by the earnings per share, which has increased from 135 cents to 189 cents, or the return on shareholders' equity, which has also increased from 21% to 26%. Okay, you guys are probably wondering, where am I getting these figures from? So let's just go to the info. And if we go down to additional information, right, let's examine our return on shareholders' equity. So if we look at our return, from 21%, the return is now 26%. And this is due to a higher net profit. Your earnings per share also has increased. So from 135 cents, it has now increased to 189 cents. Okay, so I hope, guys, that that makes sense. Remember, the more profit you have at the end of the year, obviously the higher earnings or the higher return in terms of your ratios itself. Right, so we're done with that question. Okay, so we have answered, we've provided a reason. Opinion, yes, and then we've provided reasons as to why we agree that it was a good idea paying back the loan. Okay, Abram, I think it's time for a break.
Yes, it is, Mahesh. Otherwise, Mindsetters, keep your questions coming on facebook.com/learnextra, and the timetable link I have posted on Facebook. So make sure that you get that timetable and download it and start working now, as in like yesterday, you're a bit late. Otherwise, we'll see you after the break. Welcome back, Mindsetters. And now, because of time, we are going to be tackling the challenge question, but you still have got some few minutes to submit your answers. So before Mahesh does the challenge question answer, make sure that you submit your answers on facebook.com/learnextra. Back to you, Mahesh.
Okay, right, Abram, I forgot I've got to do the challenge question, so I'm going to quickly go to that slide. Okay, there we go. Yeah, there we go. Right, guys, earlier on, the challenge question that I've asked you, you were given an extract from the financial records of XCT Limited for the year 2014 as well as 2018. So let's quickly look at the ratios that were given to us. You've got the current ratio, which is a liquidity ratio. Solvency, remember, this has its own category. This is simply a solvency ratio. Debtors collection schedule, not schedule, but debtors collection, and then we've got creditors payment ratio that's given to us as well. Both are liquidity ratios. Number of days stock on hand, another liquidity ratio, and then finally the debt equity ratio. The last ratio is a risk ratio, your gearing ratio. All right, so the question given, the directors are concerned about the liquidity position of the company, and they want you to state whether you agree or disagree, explain quoting 3 financial indicators to support your opinion. All right, guys, very, very important. Please remember, we are quoting on liquidity. We are answering a question on liquidity. And in terms of the number of liquidity ratios that I've been given in this particular table, Arjun, I want you to help me. How many ratios am I given on liquidity?
That would be 4.
I've been given 4. Okay, so my one ratio, current ratio, then I've got my debtors as well as creditors payment ratio. Number of days stock on hand is given to me. And debt equity ratio is obviously not a liquidity ratio. So those are my 4 liquidity ratios. Now, based on these 4 ratios, I need to determine, is there a liquidity problem or not? So let's start off with the current ratio. 2013, the ratio was 1,9:1, and it has now increased to 2,1:1. So obviously this ratio has improved. This shows you for every 1 rand owed in terms of current liability, the business now has 2 rand 10 cents of current asset. So this ratio clearly doesn't indicate that there are any problems with liquidity as the directors have mentioned. Let's, however, look at the other 3 ratios. So starting off with your debtors collection, debtors were taking 45 days in 2013 to pay their debt. In 2014, they're now taking 56 days. So in other words, they're obviously taking a longer time. So if you look at this ratio, it has obviously, in terms of liquidity, this ratio, the fact that they are taking longer to pay their debt means that it's going to impact negatively on liquidity. Right, the next ratio, your creditors payment. 2013, the business took 57 days on average to pay their creditors. 2014, however, the business is now taking 30 days. In other words, we are now paying our creditors much sooner. Now remember, guys, this can become a problem in terms of liquidity because our debtors take 56 days to pay the business, whereas the business is obviously paying their creditors much sooner. So remember, we are financing our debtors, and what is happening to money in our bank account? Obviously, we're losing out because we're financing our debtors and we are paying our creditors as well, so negatively impacting on liquidity. Right, the final liquidity ratio, number of days stock on hand. 2013, stock on hand 35 days. 2014, this has now increased to 60 days. And again, the fact that the number of days has now increased means that this is going to impact negatively on liquidity. Arjun, do you want to add on to this?
Well, I mean, with the ratios that you've discussed, apart from current ratio, it clearly shows to us that there is a problem, as you mentioned, because with the number of days stock that's on hand, that basically denotes that we aren't selling as much stock because the stock is remaining in our business for a longer period of time.
Okay, absolutely correct. So the 3 ratios that you will include in your answer, if, let's just, okay. Abram, I don't know what's happening today, but there's obviously, I'm doing something wrong.
Maybe it's not you.
Maybe it's not me.
No.
Okay,
no.
Maybe it's you.
Maybe it's Arjun.
Maybe it's Arjun.
maybe
Yeah.
It has to be Arjun.
Yeah, just put it on the kid.
Right, guys? But in your answer, state whether you agree or disagree. You obviously agree. There is a problem with liquidity. Explain by quoting 3 financial indicators. So the indicators that we will quote will be our debtors collection. Okay, then we have the creditors payment. And the third ratio that indicates that there is a problem with liquidity will be your number of days stock on hand. Please remember, guys, I know I'm not writing this down for you, but you need to mention or quote the ratios and obviously explain what I've already explained to you guys verbally. I know I'm not writing it down, but remember that needs to go in your answer itself. And Abram, the answers are posted on the Facebook page.
Yes, of course, in the very
Okay.
same picture with the question.
Okay.
Are you ready for the questions from the mindsetters?
Yeah, let's tackle some questions. Let's go for it.
All right, let's start here. Fayez Patel says, hey, if in the extract it says current assets excluding inventory, so far the asset test ratio, can we take that figure as it?
Okay, just read the question one more time.
If in the extract it says current assets excluding inventory, so for the asset test ratio, can we take that figure as it?
Yes, you can. Yes, you can, because they've already excluded inventory, and if they've done that for you, they've subtracted your inventory, then you can use that figure when calculating your asset test ratio.
Is that correct, Arjun?
That is indeed.
All right, I have your question. May you please explain the gearing ratios again?
The gearing ratio.
Yeah.
Okay.
What do you understand about gearing ratios?
Okay, so gearing ratios are basically a measure of the risk in the business. So a business can either be low geared or high geared. So that basically denotes if a business is low geared, it doesn't rely on borrowed capital as much. Whereas if it's high geared, it relies heavily on borrowed capital, which then negatively impacts the business.
Okay. He should be here, and I should be there.
It's all her teaching, trust me. It's all ma'am's teaching.
And you're listening too. All right, here's one for you, Mehesh.
Yeah.
What are financial indicators help us on in terms of ratios?
Okay, financial indicators are ratios, guys. Another name for ratios would be financial indicators.
So if you still have a question based on that, Kagisho, just rephrase it.
Yeah.
Nkule, what happens if the current liabilities are greater than current assets? Arjun?
Well, in that case, your current ratio would be in favor of the liabilities, meaning that your ratio would denote something, whereas you don't have enough assets to pay off your liabilities. So, for an example, it would be 0.1 to 1, which would mean you only have 10 cents in assets to pay off every one liability.
Okay, can I just explain
Yes,
that
please.
a bit? Okay, so let's say, for example, my current liabilities is an amount of 100,000, and my current assets an amount of 50,000. So if I calculate my ratio again, right-hand side, I'm going to divide by 100,000. So the right-hand side is equal to 1. If I do the same on the left-hand side, 50,000 divided by 100,000, I'm going to get a ratio of 0.5 is to 1. So exactly what Arjun explained, in this scenario, for every 1 rand that is owed by the business in terms of the current liability, the business only has 50 cents worth of current assets to pay off the short-term debt.
All right. Okay.
Right.
It makes sense. And then based on our first explanation, when you're
Yeah.
explaining question 1, there's a question that says, can you please explain what do you mean by the ratios?
Okay.
And is that table above about ratios?
Yeah. Okay. Right. I think I remember the question,
Yes.
Abram. I think there was a question about the number of ratios that you need to learn for an exam, and one mindsetter commented, "Why can't we have a formula sheet in the exam?" Okay.
Because they're just too many.
Right,
That would
guys,
make life.
unfortunately, those 17 ratios, you need to learn the formula. It's a good idea to have a formula sheet in the exam, but it's not happening this year, probably won't happen next year. Guys, I don't know when that will happen, but for now, you need to learn those 17 ratios. And like I said, make little posters. I know it sounds a bit crazy, but guys, it helps. Make little posters of all your return ratios, all your liquidity ratios. Break it down. Put it on your wall. And you know what? You don't have to put it there forever, just for this year. Okay, just put it up.
But not just put it there and leave it there, but
Yeah.
put it there.
Yeah,
and
and
then
actually
Put it there and
make
then,
use of
guys,
it.
Make
you know
use of
what?
it,
When
yeah.
you, I don't know, when you're combing your hair or using that hair dryer, just glance at those ratios, and trust me, it becomes, guys, you're laughing, it works, it really, really
It
works.
really works.
But you know what? It does become this. If I can use the word, it forms this photograph image in your mind. Okay, that these are my return ratios, these are my liquidity ratios.
I like that.
Okay.
One last more question.
Yeah.
Can you please repeat the explanation again of your net assets value per share?
Okay, net asset value per share, if I can quickly find that question. Okay, I have, let's just quickly
somewhere
go to the
here.
question.
Oh, there we go.
Okay. Right, it should be. Okay, can I, you know what, can I just quickly explain it?
Yes.
Right, my net asset value per share. Okay, here I'm taking my ordinary shareholders' equity and I'm going to divide this by number of shares that were issued at the end of the year. Okay, ordinary shareholders' equity, I get this amount from the balance sheet. Number of shares issued is normally found in your additional information. And my answer, I then multiply this by 100 if I want my answer in cents, or I can obviously have the answer in rands. Net asset value per share simply tells you what your shares are worth at a certain point in time.
All right,
Okay.
thank you so much, Mahesh.
That's
Unfortunately,
time over.
our time
Time
is
up.
really against us. But I just want to offer you this opportunity because this is our
Okay.
last show of the term. Send out your shout-outs.
Well, I'd like to send a shout out to everyone at Crawford Sanson, well, all my mates and all of us that do accounting and are taught by Ms. Lowell. And I hope you guys watched today. It was a very interesting lesson. And and to my mother as well. Hey, Mom.
Awesome. Thank you so much, Mahesh.
Okay.
Until we meet again. Hey?
Until we meet again, Abram.
Awesome. Mindset is for you, learning doesn't stop. Actually, this is the beginning. You need to work on the questions that we've dealt with and make sure that you send us your questions whenever you're struggling. We're here for you. All the best to everybody that is writing their test. Keep it calm and do more accounting practice. We love you and peace.